Hello? Hello? Yes, good afternoon, everybody. I hope you can hear my voice and at the same time see my screen clearly. So, today's webinar, I want us to. Hello? One second. So, today's webinar, the topic for today, I want us to look at how. I want us to look at how US Fed meetings affect the dollar, gold, oil, and the stocks indices. So the same meeting happened yesterday. It happened a few hours from now, back in the past. So I want us to look at exactly how these meetings, what it entails, and how exactly you can use it to know the interaction between gold, oil, and the indices. So I did some minor research here. So the Fed Reserve System is a central bank of the United States. It performs general functions to promote the effective operations of the US economy and more generally the public interest. The US Federal Reserve conducts the nation's monetary policy to promote maximum employment, stable prices, and moderate long-term interest rates in the United States. The US economy promotes the stability of financial systems and seeks to minimize and contain system risk through active monitoring and engagement in the United States and abroad. It also promotes the safety, soundness, foster payment, settlement system, safety, and effective through services to the bank industry and the US government that facilitate US dollar transactions and payments and promotes consumer protection and community development through consumer focused supervision and examination, research and analysis, emerging consumer issues, trends, community, economic development activities, and the administration of consumer law and regulations. So these meetings do not only focus on the government or the citizens of the United States. They focus on everyone within the United States and also outside the United States, from employment to interest rates to consumer protection to how laws concerning consumers are enacted. So it's not a simple thing that we could just discuss in one webinar. We want to focus on just one line of interest and that which is relevant to what was announced yesterday. So you learned, if you check online, you learned that yesterday the news, there was the interest rates was held steady. Now, our focus is going to be how does the interest rates being steady affects the price of gold, the price of oil, the price of US dollar, and the price of the stock indices. So, and how does this instrument interact with each other? How do they interact with one another? So that's going to be the focus of today, because we can't focus on everything concerning these meetings. It's very wide. It concerns a lot of things. You've seen basically that it concerns it concerns employment, stable prices, and prices. There's a wide variety of what can be known called prices, long-term interest rates in the US economy, and they promote stability of the financial systems, then seeks to minimize and contain system risk through individual financial institutions and monitor their impact on the financial systems as a whole. So this means that everything to do with the finance is actually being managed by Federal Reserve systems, because you can see they also control individual financial institutions. So not only do they control the main ones, the government ones, but they also control the individual financial institutions and monitor their impact on the financial systems as a whole. So they could come up with certain laws, certain regulations that can affect financial institutions. And this time, what you're going to focus on is the interest rate side of everything. How do the interest rate side of it causes everything? So to get that news, you can go to the FreshForex website. It's here. Let me show you in a second. So you to get to this page, you just need to come here, Forex Analytics, and then you go to FX Calendar. You click it. I just hope you can still see my screen. After you click it, this is the calendar itself. So you can browse. This is from 30th. This is a beginning of this month. Just check any news that has the word Fed before it. That is the news we are looking for. So this was on Tuesday. Sorry, this is an example of that news. Fed Vice Chair for Supervision, Barr speech. There's another one. So what you should have in mind is, there's another one here. What you should have in mind is just one thing, that the dollar controls everything. The dollar controls literally everything. So you can't just buy oil from the United States or from whatever country without the dollar. So if you want to buy anything, you change it first into dollar, and you change your local currency into the dollar, and then you now buy with the dollar itself, because dollar is like the base foundation for all currencies. So anytime there is a rule which affects the dollar itself, it affects almost everything. And when the dollar crashes, that also affects everything. When the dollar strengthens, that also affects everything, because buying and selling depends on the dollar, especially for those importing, exporting. And as you can see here, the topic is we are focusing on oil, we are focusing on gold, we are focusing on indices, we are focusing on oil, gold, US dollar, and indices. So anything like the news which was released yesterday that the interest rate is going to be is stabilized, that is it's remaining the same. Any news like that, what it does, it affects the value of the dollar. And when the effect is negative, every other person, when the dollar is losing value, it means it becomes cheaper to purchase it. And when it's easy to purchase the dollar, that means the purchasing power for many people are going to be high, which means there's going to be demand for many things across the world. Everywhere people will be known, because it's easy to buy the dollar to purchase whatever you want. And the fact that the dollar is stable is why it keeps strengthening, is the foundation for everything. And the level of political stability in the United States is very strong, that the dollar keeps just rising each and every single day. So now back to what I was looking at before. I said we'll focus mostly on the interest rates. Notice this: to buy the stocks of any company, you need to have the currency in dollar. To buy gold, you need to have dollar with you. To buy oil, you still need to have the dollar with you. So if, for example, the news could have said that the dollar is decreasing in value, or no, sorry, if the news could have said that there is an increase in interest rate, there are two forms of interpreting interest rates. There is this interest rate where you consider the cost of borrowing. That is still interest rates. The other one is the cost of the cost, like the cost of saving to the bank, the people you're saving to. So if you have a bank when you are in a bank and you work for the bank, maybe you're the manager, whoever you are in the bank, it is a common knowledge that when when your customers deposit their money into the bank, what happens is, into a fixed account in the bank, what happens is annually after a given duration, you as the bank themselves give the person who deposits the money in the fixed account some commission, some interest, like money for putting their money with you. It could be 1%, it could be 2%, it could be 3%, it could be 10%, or even 20% in very, very rare cases. So what happens is, anytime the interest rate increases for depositing, what that would mean is that many people who had their money somewhere would liquidate their assets and put that money into the bank, such that if you had $1 million and the interest rate is 20%, it means at the end of 1 year you're supposed to get 20% of whatever you deposited in that bank. So that is very good. It is very good because the interest rate is very high, and when the interest rate is very, very high, it means many people will be liquidating their assets and then putting the money into the bank. And what happens also is this: the cost of borrowing will also be very high, because many people many people deposit their money, yes, but the bank needs to pay the people who are depositing money with them. So what that would mean is that one person would come and deposit money into the bank. I'll give an example. And then when they have the money in the bank, they're told, okay, we'll give you 20% interest rate annually. Another person comes and borrows that money which the other person deposited from the bank, and they're told, okay, you'll pay us 30%. The reason being that the bank must pay its employees, the bank must pay people who have deposited money with them, and the bank also have their own past expenses that they have to meet. So as a result, the interest rate is going to be very high for those people who are borrowing money from the bank. So many people will be putting their money in the bank, but at the same time, those who want to borrow money from the bank will have the highest form of interest rate, to ensure that the bank is able to keep themselves afloat by paying the people depositing, at the same time paying those people their own, like meeting their own expenses within the banking system. So that is basically how the interest rate can affect one sector of the economy, especially after such news. So whenever they start meeting and some information is given, some speech, like you saw yesterday, there's a speech was given which says that the interest is going to remain fixed. That is, it may be a good news for one sector or a bad news for another one. If somebody was expecting an increase in the interest rate, then it remains fixed, then that could be an issue for that person. But if somebody is doing well and they expect everything to remain as they are, and that is done for them, then that is good news still. So I did some other research here, and this is what I found out. Whenever whenever the value for the dollar increases, everything literally increases. The price of gold increases, the price of oil increases, and the price for indices also increases, because we buy in dollars. Everything we purchase in dollars. So whenever there is one thing which we deal with, whenever there is the trigger is the dollar. Whenever there's an increase in the rates of acquiring the dollar, then acquiring every other thing becomes difficult. And whenever there's an ease on the dollar, then there's an ease for purchase for everything. And I found that there is a negative relation among oil price and stock indices for market. But oil prices is significantly affected by stock prices, gold, and trade-weighted trade-weighted US dollar exchange rate. So you can see here that even with the findings I have, the weighted exchange rate for the dollar still affects the price of oil, just as I've said. So oil prices is also affected by the futures prices as well as the Chinese gross oil imports. So let me explain why that is true. You've seen one of the findings is that the price of oil is affected by the importation of oil by the Chinese government. So we know very well that China is like the world industry. 90%, like a good, not necessarily 90%, but a good percentage of everything that everyone uses in the world, 90% of the chance you will find that it's made in China. A lot of things is like the world company, the world industry. So they depend mostly on oil for all whatever they're doing. The industries, most of the industries are run on oil. Most of the things are run on oil. So whenever there is something else, it is very difficult. Sorry, Chinese government depend on oil to run their industries, but they don't produce oil themselves. So they have to somehow import the oil. Now, this is where now the dollar comes in, because they will have to change their currency into the dollar and then use it to buy oil. And the more expensive the dollar is, the more they're going to be affected by the price of the dollar. So any laws that is enacted, any rule that's enacted by the Fed affects them directly, because it affects the value of the dollar, which then affects the price of oil. So something else, gold prices are concerned by changes in oil, US dollar, and stock markets, but slightly depends on the US oil importation and default premium. So something else, the Canadian dollar is the one which is affected directly by oil. Just to mention, you may not have known, but the Canadian dollar is affected mostly by the price of oil, and the price of oil mostly affects the Canadian dollar. So the trade weighted exchange rate is significantly affected by oil prices. Why is this the case? Gold prices, stock market. Why? Because you can see it here, it's clear that the rate of exchange for the US dollar is actually also affected not only by the meetings themselves, the Fed meetings, but they are also affected by the price of oil, price of gold, and the stock's market price. Does anyone know why this is the case? So let me explain it. While we've mentioned here that the dollar is affected by Fed, you can see this one thing which you need to understand, that the Fed don't only try to control the dollar, they also control consumer laws. They also control consumer laws and also some actions of the individual financial institutions. So what happens is, whenever there is a sudden surge in oil, mostly oil is imported from Canada and Russia and other countries. So what happens is, whenever the price of oil becomes expensive, that directly affects the dollar. And when the demand for gold also increases, the demand for the dollar increases, because many people would want to change their currencies into dollar before eventually they buy it. So stock market price, the same thing. This is how it affects everything. And the broad US exchange rate is also negatively affected by the US Consumer Price Index. So we're not going to look at that. So I noted that indirect effects always exist, which confirm the presence of global interdependency and financialization process of commodity markets. So what this means is, there is always at any given point, nothing acts in seclusion. Nothing is alone. Everything acts as a whole in an holistic manner. That is, everything depends on the other one. The price of dollar depends on the price of oil. The price of oil depends on the price of gold, and everything is interconnected. So when there is a meeting or a release or news which affects one thing, chances are high that it will affect other things that are closely connected to it. Is that clear? So I explain the obtained result by increasing. Sorry, there's a different one. So that is basically how everything is connected in the financial market, and how how the Fed news meeting release speech affects the price of gold, the price of oil, and the price of stocks indices. These three are always interconnected, and one affects the other one. One affects the other one. Gold affects oil. Oil affects the price of gold, and gold also are in turn affected by the price of the dollar. So this is why these meetings are very, very important and very, very significant, especially if you want to do intraday trading or long-term trade, because from what we've seen that they enact laws that affect the interest rates, long-term interest rates. So if you're a long-term investment, you better know the interest rate they are enacting. So thank you very much. That should be the end of today's webinar. We're going to meet again next week at the same time. Thank you and see you.